I do want to start out, before I even say anything else, even who I am. I do want to share that you're going to hear a lot in this presentation about things that you should do, things that guide you towards certain types of financial behaviors. But I want to be really clear about something, and this is if you hear this from anyone, not just myself. The way that you save and spend and think about money is not some sort of moral judgment, right? I don't want people to think that if you hear me or anyone talking to you about how you budget and how you make financial decisions, that it's some sort of justification in making a moral judgment against you, right? So I want to be really clear about that from the start. Now, the next thing I want to say is who I am. So my name is Lawrence Bowdish. I am from Wells Fargo. I work for their foundation, so I do a lot of philanthropic work. I'll be really clear here, not only am I not your financial advisor, I'm not a financial advisor. So what you're about to hear from me is not going to be specific advice about anything, although I will say the SpaceX IPO today went really hot. So if you happen to get in on the ground floor on SpaceX, then you probably don't need to be in this room. You should go to the beach because I can't tell you anything you don't already need to know. So just wanted to be clear about that as well. And then the last thing I'll say, even though I am a Wells Fargo employee, I'm living in Washington, D.C., I am from Panama City. So anyone, raise your hand if you're from north or west of Ocala. Anybody? I'm it. I'm the only real Floridian in this room. That's wild. You're from where? Clear? No, that's not real Florida. Okay, all right. Well, I guess I'm the only real Floridian in here from the part of Florida that is actual Florida. Okay. Well, then we will go ahead and get this going. What we're going to talk about why you need a budget, the importance of spending less than what you earn, building up an emergency fund, saving for something big, and the benefit of interest. Now, another quick rejoinder, another quick addition to this is that this presentation is a Wells Fargo presentation. It is available at handsonbanking.com. That'll be in the app, it'll be everywhere. You can go and see this presentation on your own time. Two things about that. One, we're actually retiring Hands-On Banking in 2 weeks. The links will work and will point you to the new resources, but I'm not allowed to show those yet because we haven't cleared them. So this might be the last time I ever give this presentation. The second part about this is that I'm not allowed to edit these slides. And so you might see some things in here that are like, oh, well, if you're worried about some sort of asset limitation, this slide isn't going to do you any good. I will deal with that in the commentary, right? So the slide and be like, oh, the slide doesn't help. I will try to help on the outside, okay? But I cannot edit the slides. So we're going to talk about money. Do you all know how much money you saved last month or how much you spent? Can anyone, you don't need to tell me, but can anyone produce a number of either the amount they saved or the amount they spent? Okay, we've got some head nods, that's good, that's very important, and that's really the basis of how all of this goes, is knowing that information and knowing those numbers. Now, when you do that, controlling your spending and prioritizing saving is crucial as you go through life. By doing these things responsibly, again, that's not a moral judgment, you can achieve financial security, reduce stress, and hit important life goals over time. 93% of people say that they feel like they spend more than usual when they're facing a mental health challenge. And so one of the things we're going to hit on is that you might have anyone might have a pretty good system in place month in and month out, but there might be months where that system breaks down, right? And we're going to talk a little bit about how you can sort of help adjust for those times. Now, this is something I want to make sure that we have all level set and we're all in the same place. Can you cover an unexpected expense? More than a quarter of Americans have less than $1,000 in savings. 37% can't cover an emergency $400 payment. So the state of the American consumer is not amazing. Nowadays, $1,000 in savings is not a lot. And I want to talk a little bit about sort of where we are. And a lot of times you will hear financial coaches talk about how much you should have, right? And this comes up a lot in retirement, right? And so I want you to imagine that you are 50 years old. And a lot of financial professionals will say if you are 50 years old, you should have 6 times your annual income set aside for retirement. The average household income in the United States is $80,000. I think there's a leak. Is $80,000. So that means $480,000 by the time you're 50 in retirement. But what is the actual case on the ground? If I were to take 10 Americans, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and list them from having the least in retirement to the most, the 2 people on this end would have nothing for retirement. 3, 4, 5, 6, this person would have $110,000 for retirement at age 50. 7, 8, 9, 10, this person has about 450. So you have to get to the most 10%, the highest 10% of folks before you even get to what financial coaches say is the goal. So everything you hear from me or any other financial coach, realize that most Americans aren't close to what they're saying. $1,000 in savings, being able to cover $400 expense, this is out of reach for a lot of people. And here's a rejoinder, if you are in a position where you have benefits that that you have to limit your assets with, you can't have more than $2,000 for benefit X, Y, or Z, that gets even harder. And so I really recommend, if you don't have an ABLE account, getting an ABLE account. The ABLE United folks are here. John is also from Panama City, so he's a good guy, and you can trust him to run your ABLE program. But as you think about whether or not you can save money or spend money, you have to think about this is what a budget is. And a budget helps you answer these questions about, I know what I'm doing every month, I know what I'm spending and saving, I know how I can spend less and save more, I know how I can handle surprise costs, and I know how saving can help me in the long run. Sorry. And when you create a budget, what a budget does is it helps you set up goals, because budgets that are set up for budget's sake generally don't work. If you just say, look, okay, I make $3,000 a month, and I'm going to spend $2,600, I'm going to take $400, I'm going to squirrel it away in some account with no sort of goal in mind, it's really difficult for a lot of people to do that. It's difficult to sort of just keep doing that month in and month out, even as they see that savings grow. And so what a lot of people recommend is that you come up with a goal for that savings. Do you want to buy a car? Do you want to pay off debt? Planning a big life event? Saving for college or retirement? And so I'm going to tell you how old I am, which is very old. When I was finishing high school, the top movie was The Matrix. And Neo, Keanu Reeves' character, had these really awesome sunglasses, and I really wanted these sunglasses. And back then, this was 27 years ago, those sunglasses were $85. 27 years ago. They're expensive now, they were expensive then. And I saved up. I was a busboy at a restaurant, and I saved up for 2 weeks until I had those, and I loved those sunglasses. I lost them, right? That's not the point, but I lost them, but I loved those sunglasses. And it was when I had the $87, the stack of cash, because I got tipped out, and I went to Sunglass Hut in the mall, and I bought those killer loops, that was the brand. I felt so good about that. And those are the types of things you can sort of set up, and maybe it's $87 sunglasses or a $300,000 house. These are the goals you can sort of put in mind. And again, just to say, If you have a benefit that requires you to limit your assets, you talk about ABLE accounts or special needs trusts. I have a whole team here that can talk about that and help out with that as well. So again, once you have that set up and you have that goal helps you do the other things on this slide. It helps you from spending too much. It helps you save for things you want. It helps you manage your debt and prepare you for emergencies, which is really why most people want to save at all. And so one of the things you should really do, one of the things you should take away is starting a budget and getting one going. Now, one thing I'm going to say something not on the slide here. I really recommend that you're able to do this manually. You're going to say, well, Lawrence, you're a Luddite boomer. What do you mean do this manually? I can do this on my computer and have all these apps. Well, there are a lot of apps that will do this for you. There are a lot of apps that you can tie into your bank accounts, you can tie into your credit cards, and they will pull these expenses. And they will say, oh, well, you spent $18 at Sonny's for lunch, and you went to Target and you spent $15 on this, and it'll categorize that. But one of the things I will tell you is that the way that happens, the way that information goes from Sonny's and Target to your credit card to the budgeting app only works currently because the bank allows that information to be passed for free. That may not be true for much longer. And so I really recommend, the apps are great and they let you really keep close track day in and day out, but I think the days of those apps being free are limited. And so I'd really recommend that you use the apps as a starting point, but learn how to pencil and paper. If you do a spreadsheet, when you buy something, write it down. Just do it for a month. And that sort of shows you, oh, I got paid twice and I had these 15 expenses. And as you write it down, it sort of shows you how that works. I make my 10-year-old son do that. I don't think it's helping. He still spends money poorly, but I hope it'll help at some point. And then once you have done that, you can use this pencil and paper app, whatever. You can use that to say, oh, well, I'm $200 over or $100 under, and give you a sense of what you can cut and think about moving forward in the future. I'm not gonna tell you to stop eating avocado toast or going to Starbucks, but these are the places you can see and look at that over time. And so here we just have a few slides where it shows a family talking about a budget. These folks have 3 kids, 1 in daycare, 2 in school. They work full time. They're contributing to the retirement accounts of their employers. That's important. And I'll take a side here. If you have an employer that does contribute to your retirement, that's the first thing you should do. I don't care what anyone else tells you, right? Unless you are drowning in debt and have folks pounding on your door, matching what your employer gives you in retirement should be the start. Now, you might say, well, Lawrence, my employer doesn't, I work for a small business. My employer doesn't offer retirement. I would pay close attention to the new Trump IRA rules, which are going to allow you to open a retirement account, which you can kind of do on your own right now. You can go to any brokerage account and open a retirement account. But what the Trump accounts, not the Trump accounts for youth, what the Trump IRA accounts will do is they will allow you to then apply that to what's called the Savers Credit, so the government will give you $1,000 to save for retirement. So, and that should be out in weeks. So even if you don't have a retirement plan of your own, I would think about that when you go into, when you continue to do a Trump account. Now, another aside, that as it's written in this moment could impact any benefits you have, but the Trump account for children in this moment don't. So I just want to say that real quick. In this moment, the Trump account for children do not count towards your benefits eligibility, but the Trump IRA accounts will. So just keep that in mind if you are thinking about benefit eligibility. And then going on, they have a couple of cars, they pay one off, they lease one, they're paying off student loans. They create a budget that talks about all of this. They've got the daycare, they've got the cars, they've got the loans, and the amount of money they make. And then by keeping track of that spending, they know exactly where each dollar goes, and they can save for it and they're planning for a family vacation. So that's why folks will budget. And then this might be the Barnett's numbers. Now, if you recall, I mentioned the median household income in the United States is $80,000. So if these folks make $6,200 a month, that's $74,000. So this is a pretty typical median American household. You may make more, you may make less, but this example is pretty close. And it sort of shows the types of expenses they have. A $2,300 mortgage, well, that's possible if they've had the house for a few years and they have a pretty good rate. And I'm happy, if you have questions specifically about any of these, I'm happy to take them, or I'll stick around later. If you have questions, go deeper in any of these topics, I'm happy to. $1,300 for daycare a month, that's pretty typical. $1,000 for groceries, and then the car is $700, utilities at $450, and this sort of shows them graphically where it is. And then they can see, well, they actually make $6,700 a month, so they have $400 left over to save. And again, this is pretty typical for an American household, and at $400 a month over a year is $5,000. Now that assumes there's no emergencies, that assumes there's no bills that they didn't expect, but that gives you a sense of what the median average household in the US has. And of course, the goal is to not spend all of the money at once. So that means not spending means you're saving more. So if there are things you can cut, consider cutting them, or cutting them for a month. You can decide to cut one thing one month and another thing the next. You know, there are times when, you know, my family, we will have one streaming service at a time. So we'll do Netflix for a quarter, then we'll do HBO Go for a quarter, then we'll do Hulu for a quarter. And so we just keep that going. You can do things like that. Because when you spend more than you earn, you're going to end up going into debt. And debt can negatively impact your ability to get a car or mortgage. And the next section is going to talk about that specifically, about the difference between credit and debt and why they're important. So has anyone, to this slide, has anyone ever spent money on something and regretted it later? If the answer to that is no, I got to go, hands in the back. If the answer to that is no, if the answer to that is no, you're really lucky. Can someone give me an example? Yeah, what you got, man? Hmm? And gave it to who? I'm sorry. Yeah, buy a book, okay. Yeah. Okay. And if you hadn't done that, you would have saved that money, right? Yeah. So there are times that are, you know, because this is one of the things that you'll hear folks talk about. There's something called retail therapy. I'm using you, but I don't mean anyone specific in the audience. When someone buys something, very often that's associated with a dopamine hit, and dopamine is the hormone in your system that makes you happy. And one of the reasons why that is because we live in a chaotic world, right? We control very little of the world around us. But there's something about purchasing an item, right? Having it in your hand and being able, and that represents something. You're providing for your family, you're giving someone or yourself a good time, and the purchasing, that retail therapy is that dopamine hit. Unfortunately, the dopamine hit spikes like the moment you hold the item in your hands for the first time. After that, it goes down pretty quickly. And so if you're chasing that sort of dopamine high, like, I'm not going to get into what other things that might do that, but if you're chasing this dopamine high, you have to keep buying stuff, right? I don't know if anyone here watches the show Hoarders. It's my favorite show. Like, this is someone, the hoarders are folks who are chasing that dopamine high, right? They have become addicted to that. It's the thing that makes them happy. And then part of that is they don't want to let go of it because they're confused that the dopamine is related to the owning of the item and not the purchasing of it. So this is something that you have to, you can't train the dopamine out of your body. But you have to sort of understand and appreciate that there are times when it's fleeting. And so this talks to you again, if we show this to the folks on hoarders, this would sort of show them some of that. Will you use the item, and if so, how often? Did I want this before I walked into the store or saw it in an ad? Where will I keep it? A question for the hoarders. Do I already have something like it? And do I really need it? So these are questions you should ask yourself before you wander into Best Buy or Target or any of those places to really help keep you on top and on track of your budget. And then the emergency fund. We talked about this a few slides ago, and the emergency fund is, can you handle an emergency? And we learned that fewer than 20% of Americans can handle $1,000. Only about 37% of Americans can handle $600. And it's money you set aside for expenses. And then how do you create one? Well, you put money into some sort of bank account. And again, Lawrence, I'm on a benefit that checks my assets. Well, then put it in an ABLE account. Or if, hey, Lawrence, I don't really have an issue with, any asset-limited benefits, well, then you put it in a savings account. And there are different types of savings accounts that give you different levels of interest. We'll talk about that in just a moment. And you try to reach $1,000. And again, like we talked about, that average family we just talked about, if nothing happened to them for 3 months, it would take them that long to get to $1,000. If they didn't do anything fun, if they didn't didn't do anything else, it would take them 3 months to get there. And then keep adding until you have enough to cover 3 to 6 months. Well, that family, a month of their expenses was $6,700. So 3 months is $20,000. And at $500 a month, that's 3.5 years. So these things take a lot of time, and I want to make sure when you hear me, when you hear anyone on television or the radio talk about this, this is a long-term process. So you have to some people are really good with far-off goals, right? I'm going to build a stack of cash till I get to $100,000. Some people I need to build a stack of cash to $250. And then hit those, and so build the goals based on what works for you. But just keeping in mind that, again, it would take our average household 3.5 years to get to 3 months, and that's if nothing happens. I had to replace my furnace in DC in February. $12,000, right? It's going to take me a long time to build that back up. So again, this is stuff we've already talked about. Saving for a big purchase. Again, set your goal, like I just said, lots or little, based on what you're looking for. What's your budget? What are you spending and saving in any given month? Avoiding impulse purchases. You set up checking and savings accounts. So a checking account is money you can draw from with essentially no limit, as long as you have the money in the account. A savings account will generally give you a little more interest, but you can't take money out of it as frequently or as much. And I also want to say, when you do a checking and savings account, make sure you do it with a bank that is FDIC insured. That means if something happens to that organization, it fails, it goes bankrupt, your money is protected up to $250,000. So if you are, I don't want to name others, but if you are in a financial tech app that is not FDIC insured, and you're sitting on a lot of money on an app that's not attached to a bank, and that app disappears and goes away, your money's gone. It's gone. There's no recourse, right? So you want to make sure that it's FDIC. And some of them do have banks on the back end. I'm not saying all of them don't, but ensure that you're doing that. You can make the savings automatic. Every month you can slide money into that account. And then use investment vehicles. So they're talking here about 401k, which is a retirement plan, or 529 for colleges, or 529A for ABLE accounts. We talked about making savings automatic. You can use the tools to direct deposit from one account to another. You can put this on a schedule. Or however you get paid, you can put that paycheck in whatever type of account you want. And then the reason you put the money in a savings account is that you can earn interest. I'll be completely honest with you, for most savings accounts with low dollar amounts, the interest is pretty minimal. There are a few options, what are called high yield savings accounts. Those can get closer to maybe 3%. And some of them have pretty low minimums. You might want to look for what's called an HYSA, high yield savings account. And then interest is the payment that happens on that. So if a bank, when you give a bank your money, the bank then turns around and lends it to other people. So the bank makes money off of that. For that, the bank gives you part of that money. So if I'm a bank and you give me $1,000 and I come over here and I lend it to someone to buy a car, I'm going to charge that guy 5%. And then I'm going to take that, I'm going to give you part of that 5% for giving me the money in the first place. So that's how that cycles and works. And so here's an example of that. If you put $5,000 into a 5% savings account, high yield savings account, how it works is that you have $5,000, so I'm going to give you 5% of $5,000. That's $250. But you're going to get part of that $250 every month, and I'm going to give you interest on the interest on top of that. So it actually grows quicker than $250 a year. And after 5 years, I mean, I could do the calculus for you, but it's not worth it. After 5 years, that $5,000 is $6,300. And after 10 years, it's $8,100. So it's really important to let money sit in an account that earns interest instead of putting it under your bed or putting it in some box somewhere. It's important to sort of let it do that and grow over time for you, and it protects it. And then these are some of the resources we have here. handsonbanking.com, a couple other options here. And so I want to talk a little more about credit and loans, because I've heard, even here today, some questions and comments about what credit is, what loans are, how people make these decisions. So I included this as part of the presentation. So who here knows what their credit score is? Okay, why am I here? Everyone knows everything. So a credit is, when you have a credit score is a measure of whether or not you are able to repay a loan, repay a debt. And so some of the things they look at, it's not just the amount of money that you have in an account, it's not the amount of money you make, it's a set of things that companies look at to determine if you can pay a loan. Because, as it says here, if any of you have let friends or family borrow money, that can be a tough situation, right? And you determine how you decide whether to give them money or not. And so what you'll hear a lot are the 4 C's of credit. So one is credit history. One of the things that determines your score is how well you've done with credit in the past, okay? The second is collateral. Do you have something that whoever loans you money can take if you don't pay it back? The 2 most common types of collateral for loans are houses. The house is the collateral for your mortgage, and cars, which is the collateral for your car loan. If you don't pay either of those for long enough, the bank will come and take it. So something to keep in mind. The other are conditions. Now this is one that's a little difficult for some folks to get their minds around. But in a place where, in a society, a country, where the economy is getting a little worse, unemployment's going up a little bit, interest rates are creeping up a little bit, that actually hurts your credit score. Because one of the things that credit companies look at is, well, this person lives in a place that's falling off the map. This person lives in a place that has had its major employer go down. So that person's credit score is going to go down even if that person isn't associated with the employer. So your credit score might change even if nothing is different with anything you've done. And the next is capacity. So this is how much credit can you call Who here has a credit card? Most people have a credit card, okay? That credit card has a limit. And when you start out early getting credit, those limits are pretty low. And that's how much money you're allowed to take out at any given time, no matter what. Over time, that grows. And the importance of that growing is that increases your credit score. The higher credit limit you have, the higher your score gets, because that means you have other ways to pay back these debts and these loans. So where are some places you can get credit? Well, one are banks and credit unions. They do personal loans. So if you have a relationship with the bank and you're like, hey, I'd like to have, $5,000 to, redo something on my driveway. Banks do that. Credit unions do that. Where most people get credit are credit cards. And so you apply for a credit card, shows up in the mail, you use it responsibly, you pay everything back, you pay stuff on time, your credit score will increase as you do this over and over again. The other is department stores. And so a lot of, your Targets, your Costco's, your Best Buys, they will have their own branded credit. And when you apply for a credit card, you don't apply to Visa or MasterCard. You apply to the store. And so there's that. Car dealerships, when you go to buy a car, car dealerships want you to finance the vehicle. That's how they make a fair amount of their money. And so they're going to try to give you credit to do that. And then student loans are a big place where a lot of particularly younger folks get their credit. Student loans are kind of a strange animal. Did anyone here have student loans when they went to? No one had a student loan? Okay, some people are not. Okay, so we have student loans. So here are some fun things about student loans. Do you know student loans, if your financial life falls apart and you file for bankruptcy, right? It's like, look, I can't get out from behind this. I gotta file for bankruptcy. And you have medical debt, and you have student loans, and you've got a mortgage, and you've got credit cards, and you've got personal debt. The judge is gonna say, all right, you got it. Mortgage is gone. Credit card debt is gone. Personal loans gone. Auto loans gone. That student loan, no, you still gotta pay that. Student loans cannot be discharged in bankruptcy. And so they are a really important tool. Don't take out student loans willy-nilly, but it's a really important tool to have in your back pocket because it's something that you can get really easily. The interest rates tend to be pretty good on student loans, and there's a lot of different ways to pay it back. You can pay back based on your income, you can pay back over time, so it's a really important way to build your credit over time. And the other is some stores will give credit for particular items. So if you need to finance, for instance, my HVAC company very politely offered to finance my furnace at 17%. It would have turned a $13,000 furnace over 2 years, would have turned it into a $17,000 furnace. I said, thanks, I'll figure it out. I'll figure it out. And so again, talk about credit cards, gas cards, things like that. I don't know what that slide is. This has a lot more animations than I thought. And once you have one of those credit options, you want to spend it responsibly, right? You don't want to do things that are going to impact your young life. And so you want to make sure when you have a balance on your mortgage, on a car loan, you're going to have, this is the amount you got to pay me every month. Pay it every month, right? You might be able to pay extra to it. That's great. We'll save that for a different conversation. If you have a credit card, your credit card after 2018 has to give you a couple of numbers. One is, well, this is the amount you spent last month, and if you want to pay off the credit card, that's the amount. The other number is, this is the amount you have to pay us, the minimum required payment. And then they have to tell you, if you only pay me the minimum required payment, this is how long it will take you to pay this off. And that number is usually pretty high because the average credit card interest rate now is between 19 and 22%. So you have to get those numbers. Now, if you can, you obviously want to pay it all off. Absolutely. If you can't, you probably want to pay more than the minimum because it's going to take you forever to pay it off. You want to keep your credit card balances relatively low. You want to pay on time. Don't miss payments. Stay within your limit. And one thing you can do if you're kind of worried about something, and we'll talk about fraud here in just a little bit, you can freeze your credit with the bureaus. If you call, you don't have to call, you can go online and Equifax, and you can tell them, hey, I want you to freeze my credit, which means nothing else can be done to your credit until you call and unfreeze it. So something to keep in the back of your mind if you think something is happening to your credit. And then what can happen as you get better at this, it's easier to borrow money. A lot of times, if you have a history of payment and you miss a payment, you can kind of call them and say, hey, I've paid this on time for years. And I say, hey, yeah, no problem, we'll take it off. My father-in-law had a stroke on Super Bowl Sunday. He did, for better or worse, paid everything manually. Came in the mail, wrote him a check, which was great. Unfortunately, my mother-in-law, not capable of doing that type of work. And so we had things started being cut off. And so, thankfully, we went over there. They live in Ohio. Went over there, we called the cell phone people and the cable people and all that. And because he had paid everything on time every month, every single one of them waived every late fee, right? And those are things that happen if you have this history of paying over time. You have more money in your pocket. You can get lower interest rates. When you see a car loan commercial and says, 0.0 financing, well, that's if you qualify. And you're not going to qualify unless your credit is good. Another thing that creditors look at when they determine whether or not they're going to give you credit is your credit history. So a lot of times this is just, what have you done in the past with your credit? Equifax, I'd mentioned them. These are one of the agencies that give you a credit score. TransUnion is the other. And then Experian is the third. So there are 3 companies in the United States that give you a credit score. They usually tend to be pretty close to one another. It's not like they're going to be very far off. Also, here's a hint, 80% of credit files have a mistake in them. And one of the things I recommend to you if you think there's a mistake in your credit file is you reach out to Equifax, TransUnion, or Experian directly and say, hey, my credit took a hit, and I'd like to investigate if there's a mistake on my report, and they will do it. What I don't recommend you do is that you go to a debt settlement company, because now this is different. A debt management plan is great. Like if you're in trouble and you've got a lot of credit card debt, a debt management plan by a nonprofit that does not charge you for it, I want to be real clear here, those are good, because they'll work with the credit card companies and they'll say, okay, we're going to build this out and they're going to pay us and we'll pay you, and that's great. A debt settlement company doesn't do that. What a debt settlement company does is they will tell, if Equifax gets a report that says, hey, there's a mistake in your, or if they get a report and saying, hey, you have said this on my credit report and it's wrong, Equifax has 90 days to review it. In the span of that 90 days, you are correct, right? So Equifax says, okay, they're right, take care of their credit. But at the end of the 90 days, Equifax has either said, oh, they are correct, great, keep the higher credit score, or they've said, no, they're not correct, bring the credit score back down. If they get to 90 days and neither of those have happened, the default answer is no, they're not correct, and it goes back down. So what debt settlement companies do is they will flood these folks with requests. Because of that, immediately your credit score jumps, because anything on there that is bad has gone away. Then 90 days later, it's in the toilet again, because it's determined, oh, these weren't actually mistakes. They were actually wrong. So I want to make sure people are clear if you do have, and I'm happy to talk about that specifically offline, but if you are encountering sort of debt issues and you're, because it seems like they all kind of know, because like my phone's going to give me an ad for one, I'm sure, in 10 minutes, because it heard me say it. Don't go clicking on those ads, right? Talk to a debt management, there's credit counselors that have access to debt management plans, do that. So make sure everyone's sort of clear with that. So these agencies, they track those 4 C's we talked about a couple of slides ago. They know everything about you, the way it is. They know everything about you. Whether you pay your bills on time, how much you owe, different types of accounts, where you live and work, how long you've lived and worked there. When you go to one of them to submit something, they want to know that you're you. And one of the things they will say is they will say, hi, Lawrence, you've decided to talk to Equifax. We're going to make sure you're actually Lawrence. Here's 5 addresses. You've lived at 4 of them. Which one did you not live at? And it's usually off by like a number. Like my address in Panama City was 2814 West 22nd Street, right? They might say 2815 West 22nd Street. And they know that's wrong, right? They know everything about you. The credit score goes from 300 to 850. So 300 would be essentially no credit score, or you have done everything wrong in credit your entire life. 850 is very difficult to get. The average credit score in the US is 711, which is a lot higher than I expect. Every time I see it, I'm surprised. But that gives you a sense of what the range is. Again, 300 to 850. The score helps decide if you're going to get a loan or not. And the higher the score, the better the score. I should have said that from the start, I guess. And then lenders might charge you lower rates if your credit score is higher. So it's good to have that. And again, what goes into it, we covered it. Here are some more specific examples. So types of credit go into your credit score. Do you have a mortgage? Do you have a car loan? Do you have a personal loan? What you owe, again, because they know everything about you. They know if you owe taxes. Like they know if you have an outstanding tax lien. They know that. The length of credit history, how long have you had a credit card? Another thing that you might want to, again, if you're not worried about asset-limited benefits, one of the things you might want to think about for parents in the room is get your kid a credit card and don't let them touch it, right? Just let the clock start. Or make them a card holder on your card and never let them touch it. Because if they are a card holder on your card and they get it, they can use it. But what a lot of parents will do is they will make their kid a card holder on one of their credit cards, so that kid starts building a credit history, and if your credit history is pretty good, it'll help them over time. So something to consider. And then payment, how well you've paid everything over time. And then we don't have to go over this, but this gives you a sense of what a different loan looks like based on your credit amount. So if you get a personal loan of $10,000, a 5% is only going to cost you $1,200 to borrow. If it's 15%, which is pretty high for a personal loan, that's $4,200. That costs you $3,000 more to borrow that money if your credit is good or bad. So very important. Now, one of the things, once your credit starts to build, you might get folks offering to let you borrow money. You aren't even going to them, they're going to you. That's almost always a bad idea, right? And one of the things you need to look at when you are trying to think about loans is any information here just wrong? Are they asking for documentation from your bank? You probably don't want that. A lot of times, this is really big with car dealerships, they will bait and switch on what they're going to offer you. So the commercial says 0% financing, but you get inside and it's actually 4 or 5. Sometimes this happens with certain types of mortgages, right? It's not technically a bait and switch because they tell you, but some mortgages will increase their interest rates over time. That happens less after 2008. For those of us old enough to remember what happened in 2008. There's fewer of them now, but they still exist. Equity stripping. So this means that you're not paying the loan off quick enough. Don't worry about that. Loan flipping. This is when you get a loan from someone, that person automatically gives it to someone else to collect. Fees for biweekly payments. So if you pay something biweekly instead of monthly, you pay it off quicker. And this is true for mortgages, car loans, etc. So you want to get loans that don't charge for that because it takes away the reason of doing it in the first place. A lot of animations here. And then just talking about the credit again, be smart about credit. Shop around for it. A lot of folks are going to do credit for you. Again, since 2008, a little less than used to be. But if any of you go to college or as soon as you turn 18, when I turned 18 in some year, and I got 4, on my birthday, I got 4 envelopes from credit card companies. Ready, and back then, they could send you the actual credit card. Like, I could have used it that day. They can't do that anymore, but they will come to you. Keep track of your charges. It's really easy because unlike a debit card, if you go to pay for a debit card and the money's not in your account, the transaction fails. Credit card doesn't care. Credit card lets you spend wherever you want. So keeping track of your charges and making sure there's nothing there you're not expecting. Plan your shopping, when you're looking at cars and mortgages and things like that. Pay everything on time if you can. Set limits and stick to them because, again, once you have credit, you can spend and spend more. And then get help early if you can't meet your credit obligations. Again, if your credit's good, my father-in-law, all of his creditors got rid of every late payment. Credit card companies are going to much rather hear from you on day 45 than day 90, because one of the things they do is the credit card companies can send you to a nonprofit that can help you set up a debt management plan. So a lot of them have agreements where they will do that. It's in the credit card's best interest to get their money back, even if it takes it longer than they thought it would, right? So they definitely don't want to cut you off. And then again, just the things to be aware of: paying late, ignoring savings, bouncing checks, things like that. The last thing I want to talk about, and we have some time for questions, I'll stick around, release everyone, whatever, is planning and protection. So this is going to be about your estate. This is going to be about fraud. If you have really specific questions about estate planning, most of my other co-workers from Wells Fargo are in that spot of work. I can answer a few questions and send you to them if you have really specific questions about that. So when you are estate planning, there's 10 things you need to do. And that is develop a will. Everyone here should have one. Now, I'm not saying that with a judgment. I say this all the time. I don't. Physician, heal thyself. If you need to, create a trust, right? So if you are in a position where you are concerned about what's going to happen to your assets after you pass, beyond what a will just tells the court what to do. A trust can tell those people what to do, right? So the court just looks at your will and says, okay, they wanted this, this, and this. We're going to make sure this, this, and this happens, and they're done. A trust will keep that going on the long term if you have other things you'd like to happen. Create a health care directive. What do you want to have happen to you if something happens? Create a power of attorney. Review your beneficiary forms. One of the things that's really important when someone dies is what things are payable upon death, what things can pass probate. And so if you have retirement accounts, your bank accounts, there are certain things that can pass probate if they have a payable on death beneficiary on it, right? You want to make sure that that is there, and you want to make sure that matches what your will says. So if you change one, you got to change the other, because there's nothing like, oh, I did all this, and when I set up my 401k and 5 years ago and have my wife on it, well, when I die 40 years later, I have a new will, I have a new wife, but if I didn't change the 401k beneficiary, that's not going to court. Because now my first wife is supposed to get my 401k, even though my will says it doesn't, because often the beneficiary on the 401k will overpower the will. And it's definitely going to create a question. So you want to make sure those things match. Secure and maintain life insurance, particularly for folks in the room that might have dependents, that you're worried about how they're going to fund their lives after you pass. Life insurance is particularly important. If there's term, there's whole. We'll talk about that if you'd like. Understanding estate taxes. I would gather, just using average expectations, I would gather 0 people in this room are going to have to deal with estate taxes. The level, you have to pass an estate of $13 million to pay estate taxes, right? So don't be too caught up in this, well, what's going to happen if grandpa dies and he's got $100,000, now I got to pay 30% of it. You're not going to pay a dime. Now, there are other things that do occur, right? If you inherit a house, there might be a step-up basis based in how the house is set up. And if grandma bought the house for $5,000 in 1940 and now it's worth $1 million, you're going to pay some taxes when you sell it. There's really no avoiding that unless you do it at the start. There are other things in there, but keep in mind a lot of that's not going to be a huge consideration. Consider funeral pre-planning. Sometimes you can pay for that, and that is an able qualified expense. I want to put that out there. Share your end-of-life wishes. My dad lives in Winter Park. I went and saw him yesterday morning, and he gave me what I thought was his health directive. No, it was where he wants to be buried with his wife, who's not my mother. And I'm like, all right, fine, whatever. Yeah, got it. Cape Canaveral. I'll put you in the ground. Safely and securely store your documents, safe, digital, all that. Be sure someone you trust knows where they are. And it's better if it's not someone who's in the house. If you have a business, develop a succession plan. This is really important. Even if you have a small business and you're doing gig work, not having that ready to go and not having someone being able even to close it out can be a real problem when it comes to your estate. Because what's going to happen is if you're a really successful Lyft driver, right, and you're doing everything above board, you're getting a 1099, you're paying your estimated taxes, and everything's great. Well, the problem with that is you're gonna die, unfortunately. You're gonna have a bunch of cash. You're gonna have money. That's gonna be distributed. That's awesome. That's great. And then next April, the feds are gonna go to your state and be like, you owe $20,000 in taxes. And so it's really, and that's gonna have to be paid by your state, which now has zero because they've given all the money out. So the state's gonna have to go who they paid and said, oh, you need to pony up $10,000 or you get a tax lien that you inherited from someone else. So these are the reasons why you wanna make sure, even if it's not a big deal, make sure you have someone there. And then again, this is defining what a will is. A will distributes assets to beneficiaries, and then the beneficiaries are who gets the things. All of them have it. And then the last thing I do want to talk about are scams and fraud, right? They are abundant, they happen all over the place, and all the time. To be fair, this is written for a general audience. A lot of the federal government concentration on fraud and financial exploitation is targeted towards the elderly. I cannot change these slides, right? So some of these slides might not look 100% appropriate for this audience because they're designed for the elderly, but I think it's important for this. There is financial abuse and financial exploitation. They're a little different, but we're going to talk them all about at the same time. And then you might say, hey, how you doing?
How are you?
Good, how you doing, man?
Alex, nice to meet you.
Lawrence, how you doing, Alex? How are you?
Lawrence, nice to meet you.
Yeah. Where are you from, Alex?
We are still currently living in Northport.
Northport. I know Northport.
You do?
Yeah. I lived in Sarasota.
You do?
I did. I don't anymore.
You used to live in Sarasota, and now you don't.
That's correct.
And
Yeah.
now where you live?
Ooh, I live in Washington, D.C.
Wait, I don't know what that is.
It's far away. You don't need to know where it is.
How are you?
I'm very good, Alex. How are you doing, brother?
Who's that person at the end of the stage?
Oh, so those are the interpreters. So if someone can't hear and they know sign language, they are signing what I'm saying.
This is Sparkmanized what?
It is.
Have you heard about it?
I have, although I do love Costco.
Wait.
Alex, I'm almost done. Like, when I'm done, we'll talk? Okay, thank you, Alex. Appreciate it.
I'll give you 5 minutes.
Yes, sir. I have 5 minutes, so that's good. That's good looking out. So how the scammers find you is that they will contain and they will get your information from somewhere, right? This says the dark web because this is 2 years old, back when the dark web was a scary thing everyone thought about, and now it's AI everything. So they might find it on the dark web, or they might just get it, take it from your mailbox, right? They gain your trust posing as someone. It can be a caregiver, helper, new friend, or love interest. The love interest ones are the ones that are growing the fastest. And so what's happening, particularly with AI can create videos and images and things like that. What we're seeing happening is we're seeing a lot of folks who are being catfished. Everyone know what catfished is? Okay, Pans went real fast for catfishing. You know what catfish is? 4 minutes. This is my last slide, brother. I got you. So, how you doing? So what happens is that they will send a video and they'll convince this person they're in love with them. Either that person isn't real or it's a complete scammer, and says, oh, I'd love to come from whatever, Hong Kong to Sarasota and come visit you. And they're like, oh, but I need $2,000 for the ticket.
Yes, sir.
Yeah, go to Northport, but I need $2,000 for the ticket.
About Northport.
Northport. But I need $2,000 for the ticket. So they send them $2,000. because they've spent the time and they've built this trust with them, right? And you can think of the types of folks who might be more, what's the right way to put this? More susceptible to that sort of fraud, right? I have a friend who's in my board game group. This happened to him. And he wins every board game we play. And he got catfished by someone from China. You got it. Prowl online on social media sites. That's also how they get it. Infiltrate groups you belong to. So this could all happen in person. Or go door to door. Door to door salesman. If someone is coming to your door to sell you something, you don't want it. Because either it's not real because they're trying to get your stuff, or they're selling you something you don't need. Family and close friends with ill intent. This is actually about 60% of financial fraud comes from family and close friends. And the reason for that is they don't get reported, right? You aren't going to go, there's a few agencies you can go to report financial fraud. But if it's you're a son or daughter or sister or brother, you aren't going to report them. And scammers are really good. I mean, they appeal to sympathy, curiosity, and fear.
2 minutes.
Thank you, Alex. I swear to you, I'm almost done. And their targets are vulnerable. They pick out people who are loners, people who are polite and want to help, hesitate, looking for help, or have health issues or cognitive issues.
They were playing the uptown.
Uptown. So the types of scams we talked about, there are imposter scams. I'm just telling you I'm someone I'm not. Gift card scams, they're now signs at every checkout. Do not buy gift cards for somebody. Just don't do it. If you don't know them, don't buy the gift cards for them. Tax scams, it's really easy to, and people get really frustrated and worried about tax stuff. Sweetheart scams, I talked about that already, my friend, the board game guy. Grandparent scams, a lot of times we got to, so-and-so's in trouble, can you send money? Or the grandparent gets called and, grandson is in trouble and the grandparent just sends it. Cryptocurrency or investment scams, these have come down a little bit since crypto seems to be less of a thing now. Current event scams, don't worry about that. There you go, almost done. Tech support, and then whether or not you win a prize is another one. And phony charities, this is kind of big. They didn't do it a lot in Florida when I lived here, but there'll be, people claiming they're with a nonprofit and not, and you give them money and they're not with a nonprofit. And home repairs, we talked about that. That's a big thing in Florida with the hurricanes, right? Again, from Panama City, when Michael hit, 7 years ago now, jeez. That's a big thing because people, you can't get your stuff fixed. There's not enough roofers. There just isn't in any of these places to deal with it when the hurricane comes. And so folks will come in and they will fix it, maybe, and charge you for it, but you're so desperate because the power's out and you're getting rained on. So recognize the scam.
50 seconds.
Yes, sir. I thought the last slide was my last slide, but it's not. If it's too good to be true, it isn't. If you see something, say something. Double check with a friend before you send a gift card. If you get a weird text from someone, make sure they actually have their phone. Get a hold of them, right? Do your homework, ask questions. And then FTC is who you report the scam to. It's Federal Trade Commission. They're the people that keep track of it. And I really recommend you do. And then if you've been scammed, it's not your fault. You're not alone. Don't be embarrassed. But thank you, everyone. Happy to stick around and take questions. And we'll be at a booth. I'm at a booth all day tomorrow if you have other stuff. Thank you. Thank you.